Hello. Today, we're going to take a look at mutual funds again, looking at what it means when a mutual fund is passively managed. You can check out the summary section on mutual funds here. In order for a mutual fund to grow in price, of course, the money in it has to be managed somehow. This can be done in an almost traditional way. In other words, the composition of the fund changes according to the decisions of a team of experts. When a portfolio manager makes decisions on a daily basis, this is called active asset management. Passively managed asset funds have no such decision maker behind them, but copy a pre-selected index. This is why we call passively managed mutual funds index tracking funds. This does not mean that there is no professional behind it at all, just not in the day-to-day decision making. A professional staff compiles how and which index an ETF should track, and the indexes are compiled by professionals. These professionals are certainly not just graduates of a crash course, but the best in the business. After all, the reputation of their company depends on doing a good job. To get ahead, it's good to understand what an index is first. An index is nothing more than an average. It's basically a representative sample of the stock market so that you can quickly measure performance. Without it, every company on the stock market would have to be evaluated individually, which is an impossible task. This should not be over-mystified, by the way. If you get together with your friends, weigh yourself, add the weights up and average them, you have your weight index for that measurement date. If you do this at regular intervals, you can see the change in your weight index. After a Christmas eating and drinking period, it will obviously increase. After a survival camp, it will probably decrease. If I want to divide up the lunch in an index tracking way, the heaviest will get the most, and the skinniest the least. The same way indexing works in the financial world. They buy shares based on how they performed on the stock market. The papers of a company in a prosperous period of plenty will obviously do well, while the share price of a company in a leaner period will be adjusted accordingly. Index tracking mutual funds and ETFs replicate these weights. If a company outperforms the index average, it buys more of it, and if it starts to decline, it sells. Obviously, it does not necessarily copy a selected index completely. If the fund management policy specifies that it only buys, say, the papers of the top 10 companies, then the others will be left out. But you can also stipulate that you only buy papers from companies in certain industries. The index tracking fund and ETF work in the same way in principle. The only difference is that ETF units can change hands several times a day on the exchange. The same way as the securities that make up an ETF do separately. Having looked at what index funds and ETFs themselves are, let's look at what their performance depends on. A fund's performance depends on which index the management rules designate and which part of the index it replicates. Accordingly, two index tracking funds may perform differently even if they track the same index. Performance, risk and everything else depends on what the index tracking fund and ETF invest in. These funds can invest in a very wide range of exchange-traded products and securities. It could be bonds, it could be stocks, it could be any commodity, coffee, precious metals, oil, anything. Investment direction can be foreign exchange ETF, can be industry ETF, as they can specify in the management rules which securities from the chosen index are included, so they can also specify the industry. It can be a commodity ETF, although this is more like an ETN. It is similar to an industry ETF in that it focuses on specific segments of the market. However, with a commodity ETF, you don't actually own the product. They emulate the price through derivative transactions. Derivatives are investment transactions whose value is determined by the price of the underlying product. That is, they derive the value from something else. In addition, there can be bond ETFs. As bonds are usually held to maturity, but usually until minimum to interest payment, so they have low liquidity, they are not often traded. For this reason, it is relatively difficult to create a bond ETF, but not impossible. In large enough markets the fund works, don't look for one in Hungary. And there can be equity ETFs. This is how a simple index tracking fund works. It is the most common form. As they replicate a stock market index, you can't include assets in your portfolio that you can't get in this way. This leaves out bank deposits, for example. If you are familiar with the world of finance, you may notice that bonds and equities are also available in ETF form. Just as there are bond and equity funds in traditional forms. These invest in similar areas, but their money management differs. You may ask yourself, which is better? The actively managed or the passively managed mutual fund? There is no clear answer to this question. After all, if one was far better than the other, there would only be one. Both have their advantages and disadvantages, and it is up to you to decide which one you find more appealing or accessible. Let's then look at index tracking funds and ETFs in terms of their advantages. The first advantage is that they are cheap. An index tracking fund works for pennies compared to an actively managed fund. The portfolio manager charges 1 to 2% per year for his work, and this can be much higher. What this means for you is that he charges 10 to 20,000 foreign per 1 million managed by them per year as management fee. Although fund managers employ the best qualified professionals, they have no control over market developments. This fee is deducted from you even if they are not able or allowed to produce it. An index tracking fund or ETF costs a fraction of this. They do not work for 1 to 2%, but are measured in tenths of a percent. The next advantage is that the funds are transparent. Both index tracking funds and ETFs provide you with the names and weights of the companies that make up the fund. Another advantage is liquidity. As with any investment fund, you can cash in any time. Your money is not tied up and you are not committed to any time horizon, but that doesn't mean you have to take advantage of it. Note that although you have the option, you may not have to do so. The price of a share can change, so a poorly chosen time to sell could mean a loss for you. The fourth advantage is related to transparency, and that is convenience. By using these funds, you become the owner of several shares at the touch of a button. Although the operation of the ETF is completely transparent, you can always see how much of what is in, so you could buy the underlying assets yourself one by one, but that would take a lot of time and effort. Not to mention the transaction costs, so buying them individually could get you the same thing for a lot more. As you can guess, what has an advantage has a disadvantage. These disadvantages mostly stem from automatism. Since no portfolio manager touches them, they buy overvalued paper. Copying indices also means that the fund overweights those securities that perform well. This is fine within healthy limits, but no one can stop the copying from adding overvalued stocks to your portfolio. This can end in one of two ways. Either everybody is very surprised by the company's performance, that it can even shoot out of a situation that is thought to be overvalued, well, that is the rare one, or you end up with a big upset when the balloon bursts. In most cases, it is not the whole ETF fund that collapses, it is only the part of the asset value and therefore the price that falls. Also, automatic buying results in not buying enough of the undervalued paper. Although it will include undervalued securities, securities with high return potential due to their low price, their weighting will not reach the justified level. Since the market temporarily sees no value in them, they will also be included in the index copy by the fund with a lower weighting. The next disadvantage is more related to the way risk is managed. A small company always involves risk, so investing in technology companies would require human judgment. In the absence of this, the index fund only invests in these companies when they have grown into stable and large companies. And that leaves out the growth. The management of an actively managed fund allows the portfolio manager to make decisions on new directions within their means. In a small company with a big future, it is advisable to invest in it at the beginning, so that the investor can make a big profit later on. Amazon is a good example. It went public in 1997, and for many years its share price only occasionally exceeded $20. It is currently around $3,300. If you look at the chart, you can see that it was right at the beginning that the ETF would have said no to Amazon shares. Now let's look at the risks you face when choosing an index tracking fund or ETF. It is impossible to list all the risks. So for now we'll just look at the most common ones. If I didn't do so, this section would be as long as the average drug description, where even the risk of vitamin C is listed in 3 kilometers. The first of these risks is currency risk. Since most ETFs are not invested in Hungary, your money invested in foreigns is invested in some other currency, typically dollars or euros. If the currency strengthens against the forint, you will buy fewer units for the same amount of money, and the same effect may be true for redemptions. Currency risk means that when you give the order to buy or sell, you do not yet know the rate at which it will be executed. The next risk is the counterparty risk. The ETF is backed by real shares. And these are equity securities. Although the index won't include securities from no-name companies, there is very little chance that a large company will suddenly go bankrupt. However, this is not impossible. The fund has no control over this, and if it does happen, the part of the fund that the bankrupt company has created will be worth practically zero. The following risks are economic, political and interest rate risks. None of these are beyond the control of any fund manager. This means that changes in the inflationary environment, tax regulations, and the interest rate set by the central bank will have an impact on other market participants and therefore on the performance of the fund. Quick example, just for illustration. If the central bank raises interest rates, the interest rate on risk-free investments will also rise. This does not change the risk of the investment fund. Investors would obviously want a higher return outlook for the extra risk taken, which if they don't get, they won't invest their money here. This in turn leads to a fall in share prices. The next risk is leverage. Leverage means that if the underlying product, security, whatever the ETF is tracking the price of goes up 1%, then the price of the ETF will not go up 1%, but will go up by the amount of leverage, say 2%. Obviously you can gain more, but what is true upside will be true downside. So as much as you can gain with leverage, you can lose with it. This is the risk of leverage itself. By default, the ETF does not contain leverage. This is specifically pointed out to you in the ETF description. If you have chosen a leveraged ETF, you should be aware of this risk in the same way as you would be if you were to take on this risk in any other case. Now let's look at what to look out for when investing in index tracking funds or ETFs. The first thing to look out for is the investment time horizon. The same applies here as for the recommended time horizon for actively managed mutual funds. The fund manager will specify this time horizon in the fund description according to the risk level of the fund. If you don't have that time to achieve your financial goals, you may not be right for the fund, however attractive it may be. Although you can sell your ETF unit at any time, you should be aware that there is a risk of loss within the recommended time frame. The second thing to look at is the investment direction. There are real assets behind both the index tracking fund and the ETF. The performance of these underlying assets, and therefore the performance of the mutual fund, depends on which area, either geographic or economic, it focuses on. Before investing in anything, look carefully to be aware of the expected outcome. Third is the fund's past performance. I would remind you that it is not a good idea to choose an investment purely on the basis of past performance, because you can easily find yourself in a situation where you get in at the top of the upswing just before the downswing. But you still need to know how the fund you like has performed so far compared to others, because your money may be managed more efficiently elsewhere. This is called looking at the benchmark. If you are investing individually through a securities account, it is important to know the tax issues. If you do it through insurance or a solution built into a banking product, the financial institution will do it for you. For ETFs, your fund manager may pay you dividends on the underlying shares, in which case you will be liable to pay income tax, or they may be included in the fund's price. If it does, you typically only have to pay tax, also known as interest tax. After knowing these items, determine what investment strategy you want to follow. An ETF unit is a good way to get the average performance of the market without paying too much attention to it. Nor is there any problem with sitting on it, buying it and then selling it once. This is the buy and hold strategy. It's also perfectly fine if you decide that you want to realize the gains you've made at regular intervals, as with individual securities, so you sell and buy something else instead. The problem starts when you mix the two investment strategies and jerk the whole thing around. Finally, determine your own risk level. To do this, you need to know how risk-seeking or risk-averse you are and what your time horizon is. The longer your time horizon, the more courageous can be your choices. As a beginner, you should do this if you can bear some risk yourself and have help behind you. After all, just because an investment is risky doesn't mean it will pay off. We can help you choose the right investment direction for you. See the link in the description for contact details. After that, let's look at what to do and what not to do if you want to buy an index tracking fund or ETF. If you are just learning about the subject, the first thing you can do is do nothing. Buy nothing? Do nothing. At least not recklessly. Instead, learn about the subject or seek expert help. The average beginner's strategy is very simple. They decide whether to buy or sell based on past high returns, and if the price falls, they panic and run. That is, he gets in at the top of the uptrend, when he should be buying because everything is cheap, and then he sells the expensive mutual fund or whatever. He jumps on his emotions, which is not a good strategy. The end of this is paying tuition fees. We can save you that. In conclusion, by using index tracking funds and ETFs, you have the opportunity to cheaply and conveniently build a well-diversified portfolio according to your own financial goals and risk tolerance level. As with all investments, it's important to remember that return and risk go hand in hand, so do your research before making any decision.